Hello everyone and welcome to another episode of Common Law in Simple Flow. Today we are going to talk about last topic of business taxation. Tax anti-avoidance. To start the topic, let's firstly differentiate tax evasion versus tax avoidance. Tax evasion is illegal. It's deliberately hiding or falsifying facts to reduce tax. For example, underreporting income, showing less income, so to say, fabricating expenses, using fake invoices, cash in hand, not declared, when you are receiving cash and not declaring it. Tax avoidance is within the law. It's arranging your affairs to reduce tax by relying on legislation as written. For example, using an ISA, claiming statutory reliefs, choosing a tax-efficient business structure. It might fail if HMRC or a court decide the arrangement doesn't work, but trying it is not a crime. Abusive avoidance arrangements. Abusive means the arrangements can't reasonably be seen as a sensible, normal use of the tax rules when you look at what Parliament intended. So when you are trying to understand whether the arrangement is abusive or not, the first thing you need to pay attention is the intention of Parliament. What the Parliament intended with the tax rules. Let's view some red flags. No real commercial purpose other than tax. The deal only exists to save the tax. In this case, the deal will be seen as abusive avoidance arrangement. Second one, contrived or circular steps. Money goes round in a loop and ends up where it started. Basically, money starts its journey, goes through some processes, and eventually ends up in the same place where it was. And the purpose was tax avoidance, so to say. Artificial losses or income created on paper, but not in substance. Basically, you had loss or income, but that was only on paper. In reality, there was no loss or no income. Exploiting a loophole to get a result Parliament clearly didn't mean. So the laws, taxation laws, are not perfect, and if you find a loophole and do something that Parliament wouldn't wish and wouldn't intend and didn't mean, that will be abusive. Abnormal features, for example, non-market terms, pre-arranged offsetting, steps done and undone quickly. Just generally said, abnormalities. How HMRC stops this? The General Anti-Abuse Rule, GAR, lets HMRC counteract tax advantages arising from tax arrangements that are abusive. GAR isn't a standalone GAR Act. It's a set of statutory provisions in UK primary legislation, specifically Part 5 of the Finance Act 2013, with related schedules, and it's applied across many taxes. HMRC's GAR guidance, approved by the GAR Advisory Panel, sits alongside it to explain how the law is applied. So GAR isn't an act, it's a part of another act. The act is Finance Act 2013, and GAR provisions sit in the Part 5. But on the top of that, there is GAR guidance in order to explain how those GAR rules are applied. And this GAR guidance was approved by the GAR Advisory Panel. Okay, too many GARs. Now let's understand how we are going to apply GAR, General Anti-Abuse Rule. Here is a checklist of 5 questions which all should be answered with yes in order for GAR to apply. If any of them is no, the GAR does not apply. So, the first question is there an arrangement that creates a tax-saving advantage? Arrangement is extremely broad. It can include any deal, scheme, series of steps, or understanding. Tax advantage is also broad. Less tax now or later, more reliefs, creating losses, timing shifts. So the first question is generally, is there an arrangement that creates a tax saving or advantage? So there should be some arrangement. If it is a deal, some steps, or just understanding of doing something, and that should create a tax benefit, so to say, an advantage. It can be a less tax now or later. It can impact in more reliefs, tax reliefs that you have. So the first part is only about, is there something that have caused a tax advantage? Does the saving relate to a GAR covered tax? So here are the taxes which are covered by GAR. Yes, if it's one of the listed taxes: income tax, corporation tax, CGT, capital gains tax, inheritance tax, stamp duty, land tax. We know that stamp duty is only for land transfers. National insurance contributions, petroleum revenue tax, annual tax on enveloped dwellings, ATED, diverted profits tax, apprenticeship levy. So now we are thinking, okay, what we have missed? And we have VAT that is not in GAR. VAT has its own anti-abuse doctrine developed in EU, CGEU, case law, for example, Halifax. So GAR deliberately doesn't apply to VAT. What we need to remember, that VAT doesn't apply for GAR. Mostly everything else applies for GAR. Other taxes generally outside GAR include things like insurance premium tax, excise duties, and stamp duty. Stamp duty for land tax. No, stamp duty for land tax is covered. SDRT is not covered. SDLT is covered, but old stamp duty, SDRT, is not covered. But old stamp duty is not relevant anymore. So what is important for us to remember, that VAT is not covered by GAR. And national insurance contributions, petroleum revenue tax, the main tax types that we have already learned, SDLT, the stamp duty tax, they are covered. Okay, main tax purpose test, the third question. Looking at all the facts, is it reasonable to conclude the main purpose was to get that tax saving? This is an objective test. So it's not about what the taxpayer says, but what a reasonable observer would infer. We are not trying to understand subjectively the feeling of taxpayer, because the taxpayer may think that they are not reasonably doing anything which purpose is to save the tax, and it just happened automatically. So the objective test will provide us answer what a reasonable observer would think about this tax saving. Was the purpose tax saving or not? HMRC must prove that the arrangement is mainly tax arrangement, namely the main purpose of it was to gain tax advantage. So this is something that HMRC should prove. And it's not so that the taxpayer should prove that the purpose, sole purpose, or main purpose was not the tax saving. Abusiveness test. Double reasonableness. Is the tax arrangement abusive? Even if the main purpose was tax, GAR only bites if the arrangement cannot reasonably be regarded as a reasonable course of action in light of what the law was meant to do. This double reasonableness is really complex, so let's try to understand what it exactly means. It's called double reasonableness because the statute literally asks reasonableness about reasonableness question. Are the arrangement ones that cannot reasonably be regarded as reasonable course of action in light of the tax rule's purpose? Would someone think the course of action is reasonable in relation to the legislation's purpose? And taking all views into account, is it reasonable to regard that view was reasonable? This, to be honest, explains more what we're trying to achieve with double reasonableness. So, we are taking a person and trying to understand, would this person think the course of action, this tax saving process, the steps that have been done for that, is reasonable in relation to the legislation's purpose? So, is it reasonable to consider that this action is aligned with the purpose of the legislation, the parliament's intention? And taking all views into account, now we are generally viewing, was that person's reasonable thinking reasonable at all? Only if HMRC shows both layers fail, the arrangements cannot reasonably be regarded as reasonable. So in the first place, was the thinking reasonable and was the action reasonable? So was the thinking of another person of that action was reasonable? Only if HMRC shows that both layers fail, only in that case the action will be considered as abusive. This sets a high threshold designed to catch contrived schemes while protecting ordinary planning. HMRC must prove on the balance of probabilities that it's abusive. Balance of probabilities is following. HMRC must show that it's more likely than not, more than 50% likelihood that the arrangements are abusive under GAR. In contrast, in criminal cases, we use beyond reasonable doubt, which is much higher bar of 95% certainty. So if HMRC evidence tips the scale even slightly in favor of this arrangement can't reasonably be regarded as reasonable use of the rules, the balance is met. If the evidence is evenly balanced, HMRC loses on GAR. So important is that HMRC provides evidence that these actions that have been done, firstly, are not reasonable, and it's not reasonable to think that it was reasonable. What evidence looks like in practice? Documents, term sheet, board minutes, emails about motives, the commercial effects, cash risk, really moving or not moving, expert evidence on market terms and how the steps align with the purpose of specific tax provisions. So what is important here to figure out that the last step of checking whether there was a GAR abusive action, firstly we understand, was there any arrangement, a deal for example, that saved the taxes? Then secondly, does this relate to a tax that's included in GAR? So if it's not VAT, it's highly probably included. And these are only 4 questions. Although it was written 5 questions because this double reasonableness is basically combined. Then main tax purpose test, looking at all the facts, is it reasonable to conclude the main purpose was to get tax saving? So what is reasonable? Was it reasonable to conclude that this action was done to save taxes? And then we have the double reasonableness. Would someone think the course of action is reasonable in relation to the legislation purpose? And taking all views into account, is it reasonable to regard that view was reasonable? So firstly, we are building a view whether the action was reasonably aligned with legislation purpose, and then we're questioning whether that view was reasonable or not. If GAR applies, HMRC makes just and reasonable adjustments to remove the tax advantage and may charge GAR penalties. So they are making adjustments in the taxing processes so that this tax advantage is removed, and there may be GAR penalties as well. Here, let's go through an example. A promoter sets up a Creative Ventures LLP and gets high earners to invest 200,000 cash each plus 800,000 non-recourse loans. So each has 1 million at risk on proper. The LLP runs circular low substance deals that generate a 1 million trading loss per partner in year one. Each 45% taxpayer claims sideways loss relief to save 450,000 tax against their other income, despite only putting in 200,000 cash and there being no real prospect of commercial profit. So the partners are investing 200,000 and then they are getting 800,000 loans, and somehow they are getting 45% loss and are able to save this 450,000 tax loss against their other incomes. Let's say they have 3 million from other companies, other businesses, and from here they get, with combined tax relief, they are getting 450,000 loss relief against their other incomes. HMRC would likely treat this as abusive income tax avoidance. So main purpose is tax advantage, not a reasonable course of action. The HMRC will deny the loss relief and pursue tax, interest, and penalties as well. So they will get back the tax that should have been paid, there will be an interest on top of it, and there will be penalties. So especially this double reasonableness part, it may be a bit difficult to understand, but important is to remember that double reasonableness is part of the test itself. So why there is written 5 questions if it was only 4? Because the 5th question is about the materials that the HMRC will use to understand whether this contradicts to GAR rules and there is abusive action. But this will be covered more allocated throughout other branches. So now let's continue from this double reasonableness part. In practice, HMRC points to features like contrived circular stamps. A company sells an asset to a friendly party at a loss at 10 and buys it back at 10.15 under a pre-agreed contract, so cash and risk end up exactly where they started. The only point is to book a paper loss. You enter a derivative with a bank and a mirror derivative with an affiliate, so real risk is perfectly hedged. But accounting timing differences create a large tax loss this year to shelter profits. Economically, you are flat. So this is artificial loss. And then we have non-commercial terms. An interest-free loan of 20 million between connected parties where no third-party lender would ever agree to those terms, inserted only to shift profits to a low-tax entity. So an interest-free loan, there is a loan without any interest. For example, 20 million loan provided between parties without any interest, where no third-party lender would ever agree to those terms, because for lender, interest is very important. So again, tax evasion is the only purpose. Results that defeat Parliament's purpose. R&D, such as the research and development, tax relief, which is real in UK. The UK has legitimate statutory R&D tax reliefs, now merged into R&D expenditure credit. This regime with special rules for research and development it's the situation when you genuinely spend on qualifying research and development, you can get an enhanced deduction or a credit that reduces corporation tax or pays a credit to loss makers. So this R&D, research and development tax relief, there is such tax relief, and the whole idea is that you use this tax relief in an abusive way. For example, UKCO pays £1 million to an overseas group company for R&D. Hidden side deals send most of that money back to UKCO, for example, back-to-back loan or a rebate or circular fees. On paper, UKCO claims we spent £1 million on R&D, please give us relief. In reality, UKCO didn't end up out of pocket and took no real R&D risk. The work delivered is minimal or just for show. So you are in fact just circulating the same amount of money. You are paying 1 million to another company for R&D relief, and say you are getting this R&D relief, you are getting an advantage, but this 1 million eventually lands back to your bank account in some other ways. Okay, so these were also some examples what can happen that will disbalance GAAR. Now let's talk about GAAR counteraction life cycle. HMRC inquiry is the first step. HMRC suspects abusive avoidance. This is the first step. HMRC tries to get more information because they suspect abusive avoidance. The second step, GAAR counteraction is proposed. So you'll typically see a GAAR notice, and HMRC may seek an opinion from the GAAR advisory panel. What will happen? Let's say HMRC gets suspected about abusive tax avoidance. They send you a GAAR notice, and HMRC will at the same time seek an opinion from GAAR advisory panel. And this is where HMRC proposes this GAAR counteraction. Taxpayer can disagree. The matter can be appealed to the first tier tribunal and beyond. If taxpayer agrees, then HMRC was right. That was abusive action from the side of taxpayer. So an action needs to be taken. But if they disagree, so if they have agreed, they need to pay the tax and there will be some penalties and interest maybe. But if they disagree, then they are going to first tier tribunal. If the case reaches a tribunal court, the judge must take into account HMRC's GAR guidance, the version approved by the GAR advisory panel at the time you did the arrangements. So they look when the arrangement was there, because it's important that your actions were aligned with the GAR guideline of that time, if the action was like 3 years ago, because GAR guidance may change. The judge must take into account any advisory panel opinion on your arrangement, because here HMRC also asks the GAR advisory panel for opinion, and the judge will take that opinion into account. The judge may also consider other public guidance statements that existed at that time and evidence of established practice back then. So if there were some established practices and also other public guidances and statements, the judge may also consider that. So it's important, the word may, because they do not have to do that. But what judge must do, they must take the GAR advisory panel opinion into account, and they must also take into account the GAR guidance of that time. And let's mark may with maybe green color. Yeah, now it makes sense. So judge must take into account the GAR guidance, must take into account advisory panel opinion, but may consider the public guidance statements. Okay. What does may also consider other public guidance and established practice means? When a GAR case reaches a tribunal court, the judge can look beyond the statute to context that was publicly available at the time you did the planning. For example, public guidance statements. Things like HMRC manuals, HM Treasury, HMRC budget notes or explanatory notes, published statements of practice, and guidance from professional bodies that were on the record then. Established practice, how a rule was commonly applied in real world at that time. For example, what taxpayers and HMRC typically did in practice before your dispute arose. The idea is to avoid hindsight bias. The court asks, given what was publicly known and commonly done back then, would a reasonable person see this as a reasonable use of the rules? So on the first side, we need a reasonable person, and secondly, reasonable use of the rules. Not just any person would think the rules were reasonably used, but what a reasonable person would think about the reasonability of the rules. And this is the double reasonableness. But important is this may part, because it may be sometimes tricky that you may think the court must also look at this guidance. R&D example. If at the time HMRC's public manuals and industry practice accepted certain subcontracted costs as qualifying with conditions, the court can weight that when judging whether your setup aligns with the rules, purpose, or crosses into abuse. Must versus may, what I've already mentioned. Why this matters. The court must consider GAR guidance, approved versions, and any GAR advisory panel opinion. So the GAR guidance and GAR opinion. The court may consider other public guidance statements and established practice at the time. So this is helpful context, but not mandatory. So the court will decide they are going to look at it or not. You must file your tax as if GAR applies. HMRC can then formally undo abusive savings and may add a penalty, unless you fix it yourself first. So the whole purpose of GAR is to make sure that the taxpayers apply submit their taxes, file their taxes as if GAR applies. So they are not thinking that GAR applies only when HMRC initiates and triggers it. So HMRC can formally undo abusive savings. So all the savings that you had, they will just undo it and you will have to return it, and may add a penalty unless you fix it yourself first. There is no advance clearance for GAR. You can't ask HMRC, is this OK beforehand, unlike some targeted rules, transactions and securities, where you can ask HMRC to confirm. So there are some targeted rules generally where you can ask HMRC. For example, transactions in securities, you can consult with them and ask if this is okay to do so, can they confirm? But with GAR, there is no confirmation. Though HMRC is not obligated to confirm that you are aligned with GAR, you are still obligated to self-assess your tax correctly, taking GAR into account. This is relevant. So the HMRC is not obligated to say whether you are aligned with GAR or not, but you have obligation to make sure that you are aligned with GAR. It's no excuse that you say, oh, I didn't know about the GAR. You can still avoid the GAR penalty even after HMRC raises it, but only if you fully fix things within the deadline HMRC gives you. Option A. Fix early before HMRC says anything. Amend your return claim to remove the abusive saving and pay the tax plus interest. There will be no GAR penalty to that. If you fix before HMRC says anything and before they provide this GAR notice. And option B. Fix after HMRC flags GAR. HMRC will issue paperwork, for example, GAR counteraction notice, that includes a correction window. If within that window you amend, withdraw the claim, accept the counteraction, and pay the tax plus interest, then no GAR penalty will be there. So in both of these cases, when you fix the problem early before HMRC says anything, or after HMRC flags the GAR abuse and sends you counteraction notice where they provide a window, if you remain in this window and fix the issue, you will again have no penalty. If you don't fix by the deadline and you carry on contesting, then you lose. The HMRC can charge the GAR penalty up to 60% of the counteracted tax advantage on top of tax and plus interest. So you are not just paying the tax that you have saved, interest on it, also 60% on that tax advantage that you had. It's very harsh penalty. Example setup. You filed a return claiming an arrangement that reduced your tax bill by 120,000. HMRC later applies GAR and says that 120,000 pound is an abusive tax advantage. It's counteracted amount. Case A. You fix it yourself early before HMRC raises GAR or HMRC issues GAR notice. You fixed within the HMRC deadline. Tax to repay is 120,000. Interest, let's say 9,000 pounds. And GAR penalty 0 because you fully removed the advantage yourself. Total tax is 129,000. Case C, you contest, lose at tribunal and didn't fix by the deadline. You have to repay now the tax advantage that you had, 120,000, the interest of 9,000, and then GAR penalty, which is up to 60% of the counteracted tax advantage. So you're not counting interest in it, only the tax that you have avoided. And it's 60% of it, so it will be 72,000 £201,000. Total payable will be £201,000 if you combine all these three together. Okay, we have covered this branch as well. Now let's move to corporate criminal liability. Corporate criminal liability. Under UK law, a company itself, not individuals in the company, can commit a criminal offense called the corporate criminal offense, CCO, of failure to prevent the facilitation of tax evasion. Only a relevant body, company, partnership can commit this failure to prevent offense. Individuals cannot commit this offense. So this corporate criminal offense, usually you think a criminal offense can be committed by individual only, but this corporate criminal offense is only for corporations, and a person cannot commit this crime. Now let's delve deeper. Someone evades tax, that's a crime. An associated person of your business, employee, agent, contractor, criminally helps them do it while working for you. Your business didn't have reasonable prevention procedures in place. Your business can be criminally prosecuted even if the company didn't benefit. So let's say person E commits a tax evasion crime. So they evade a crime, and you remember tax evasion is illegal and tax avoidance is legal. Let's say someone is committing a tax evasion crime and another person in your company, which is associated person, helps them to commit this crime. Basically, you haven't done anything wrong as a company, and your employee also haven't done anything wrong. There is just this person A who has evaded taxes, and your employee, agent, contractor criminally helps them while working for you. So they work for you but help other to evade from taxes. Your business didn't have reasonable prevention procedures. So it's about whether you were able to prevent that your employees do not help other people to evade taxes. And the missing of this prevention mechanisms makes you criminally liable as business. So corporate criminal offense. You will be criminally prosecuted even if your company didn't have any benefit. So you and your company received nothing. Just your employee helped another person to commit a crime. What counts as an associated person? Anyone providing services for or on behalf of the company. Staff, sales agent, introducers, certain contractors, subsidiaries. So anyone who is providing services for you or on behalf of you as a company. So for the company or on behalf of the company will be considered associated person. Penalties if the company is convicted for this CCO, corporate criminal offense. Unlimited fine, possible confiscation of assets, and serious reputational damage. Banks, regulators, tenders. So unlimited crime is very serious. This is separate from any individual's prosecutions of the employee agent and from the original tax evasion case. So this tax evasion case of another person is separate. Your employee's actions are separate. And you as company will be also separately prosecuted. Once again, unlimited fine, possible confiscation of assets, that people come and take your assets, and serious reputational damage. The full defense, how company protect themselves. Show you had reasonable prevention procedures in place at the time, such as risk assessment, where could facilitation happen. So you have risk assessment prevention procedures. Proportionate policies, controls, approvals, red flag checks, top level commitment, board ownership, due diligence on clients, agents, intermediaries, training and clear reporting, escalation channels, monitoring, and periodic review. If those were reasonable for your risk profile, the company has a complete defense. So you will have a full defense if you can show that you had reasonable prevention procedures in place at that time. And this will save you. Okay, employee example. A relationship manager teaches client how to hide income using sham invoices. If the firm had no training, no policy, no oversight, firm risks CCO prosecution. It's a good example. Your manager is teaching a client how to hide taxes. Agent example overseas. A commissioned agent sets up a structure to help a client dodge foreign tax, acting for your UK-based firm. If you didn't vet, train, contractually control the agent, the firm risks CCO, the corporate criminal offense. The law can reach foreign facilitation in many cases. Failure to prevent under CFA 2017 is a corporate offense only. Individuals don't commit it. The associated employee could separately be liable under other offenses, but not under CFA failure to prevent the charge. So the CFA is Criminal Finances Act, and Criminal Finances Act sets this corporate criminal offense only for companies. Individuals do not commit it. The associated employee could separately be liable under other offenses, but not under criminal corporate offense. Under CFA, the Criminal Financial Act, only the company and also the person who is committing the offense, tax evasion, can be liable. The person who commits the crime, be it employee or self-employed, is also liable, but once again, this is not the person who is assisting from the company's side commit the crime. The assisting party will be only associated person and will not be liable under CFA. So, assisting party will only be associated person and will not be liable under CFA. So, under CFA, only the company and also the person who is committing the offense will be liable. So, the company will be liable under CCO, corporate criminal offense, and the person who is committing offense can be liable, the person who has committed the crime, personally, criminally liable, but not CCO. So it's important that a person cannot be liable under corporate criminal offense because it's already called corporate. Okay, now fraudulent tax evasion. Fraudulent evasion of income tax is a criminal offense. It overlaps with the old common law offense of cheating the public revenue. If HMRC wants to prosecute for fraudulent evasion of income tax, they must prove the offense, including dishonesty, because in criminal cases, the burden of proof is on the prosecution beyond reasonable doubt. So we know that in criminal cases, the prosecution will need to prove something. The burden of proof is always on prosecution in criminal cases. It's in civil cases that it depends whether the claimant or defendant will prove something. So let's now again understand what we're talking about here. Fraudulent evasion of income tax. This is our subtopic. And this fraudulent evasion of income tax is a criminal offense because evasion of income tax, we have discussed in the beginning, tax evasion is illegal. It's a criminal offense. Tax avoidance was okay if it was within the law. But this evasion of income tax is criminal offense. It overlaps with the old common law offense of cheating the public revenue. So cheating the public revenue was the old common law offense. Some crimes can be heard in either the magistrate's court for less serious cases, quicker, lower maximum penalties, or the Crown Court for more serious cases, jury trial, higher maximums. Fraudulent evasions of income tax is one of those. Venue depends on seriousness, complexity, and amount, and they are called either way offense. So, for fraudulent evasion of income tax is one of those that it's called either way offense because the venue depends on seriousness, complexity, and amount, and those are called either way offense. So we have on one side the magistrate's court, which is not for super serious claims in cases, and Crown Court is for serious with higher maximums, and they are fraudulent evasions. They are not automatically sent to Crown Court. They depend on their seriousness, and it's called either way offense. It's committed, this fraudulent evasion income tax is committed if a person is knowingly concerned in fraudulently evading income tax, either their own tax or someone else's. So it's not always your own tax. You may help as an employee, as an agent, as a friend, others to evade their income tax. And this is considered criminal. Both employer, manager, and employee may be liable if the manager knowingly supports the employer to avoid income. So if the manager knowingly supports the employer to avoid income, you will be also doing fraudulent evasion if you are knowingly supporting someone else or helping them to evade their income. Here we have differentiation of knowingly and concerned. Knowledge, not just a hunch, suspicion that income tax is being evaded. So we don't need a suspicion. Oh, maybe that income tax is being evaded. Courts say knowledge includes willful blindness. For example, deliberately turning a blind eye to obvious red flags. Let's add a red star here, because this knowledge part is important. You are basically not just suspicious. Maybe Arnold is trying to evade taxes. No, you know that Arnold is evading taxes and you willfully close eyes on this. Show that you don't even know. And concerned, actual involvement in the evasion, helping, organizing, covering up. So knowingly concerned is you're knowingly concerned basically when you have knowledge, not just suspicion, and you actually help organize or cover up the person. So you do something. Now let's go through this knowledge. Willful blindness example. You strongly suspect invoices are fake and you choose not to check because you want the tax saving to go through. That can count as knowledge. So you strongly suspect, but you choose not to check. And this not to check is the important part, because there is a suspicion, but there is also inaction where you actively not doing anything. Suspicion only example, which is not enough. You have a vague worry, something is off, but no clear indicator, and you don't take any steps that assist. Just feeling uneasy doesn't meet the test. So you have just a suspicion that maybe something is wrong. The offense is about evasion of income tax, a tax that applies to individuals, some trustees, partnerships for certain purposes. This is also relevant. So it's about only income tax and not corporate tax or VAT. But the offender can be any person, including company, if they are knowingly concerned in someone else's income tax evasion. For example, employer, company running off books payroll, an accountancy firm filing false returns. If the target tax is corporation tax, that's a different offense, not evasion of income tax. Likewise, pay national insurance contributions and VAT have their own offenses rules. So it's only about income tax. Corporation tax have different offenses. Pay and NIC, national insurance contributions, VAT, they also have their separate ones. Okay, now the last two branches, TAR and phenixism. Okay, TAR, Targeted Anti-Avoidance Rule. TAR disallows artificial capital losses for capital gains tax, CGT. If the TAR is engaged, your loss simply doesn't count. It isn't an allowable loss, so you can't offset it against gains. So TAR is mostly about CGT, the capital gains tax. If a capital loss arises in consequence of arrangements where the main purpose or one of the main purposes is to obtain a tax advantage, that loss is blocked. So we have two important words here, arrangements and tax advantage. So if this capital loss is in consequence of arrangement, so you have an arrangement due to which there is a capital loss and there was a main purpose of tax advantage, then it is blocked. So we have the same in GAR. We have an arrangement that creates a tax saving advantage. And you remember that this also applies for capital gain tax. VAT was only excluded from GAR. And we will now understand why we need TAR at all. So, an arrangement is any agreement, scheme, transaction, or series, any deal. It is again wide. And tax advantage, relief, increased relief, or repayment, increased repayment, reducing or avoiding a charge, assessment, or avoiding a possible assessment. So basically a tax benefit. You sell assets to a friendly party at a contrived low price at 10 and buy it back at 10.15 under pre-agreed steps, so you are not economically worse off, but you have created a paper loss to shelter other gains under section 16. That loss can be disallowed. So this is just transfer of an asset in order to create an artificial loss. Just here to not to forget it, that TAR is about capital gain tax. So this is a civil computation rule. It disallows the loss. It's not a criminal offense by itself. If there is dishonesty, for example, fake documents, that's a separate criminal path, cheating the revenue fraud. But the TAR itself is just disallowance rule. TAR is basically not allowing the loss to actually be there, to actually happen. And TAR framework covers individuals, personal representatives, trustees, and companies. TAR applies to anyone who's within CGT rule, corporate gain tax rules, including non-residents on UK property. From 6th of April 2015, non-UK residents became chargeable on gains from UK residential property. From April 6 of 2019, the charge expanded to all UK land property, residential and commercial, and certain indirect disposals. For example, selling shares in a company whose value mainly comes from UK land property rich company. Once a non-resident disposal within scope of UK CGT, then TAR can be engaged if loss is artificially created. So when does the UK tax when does the UK tax you, United Kingdom tax you, as a non-resident? 2 quick tests. Property reach test. The company fund is UK property reach if at least 75% of its value comes from UK land property. So we say a UK property reach, a company's UK property reach if 75% of the value. So why they are rich? Because 75% of their value comes from UK land property. And ownership test plus connected people. So you plus connected people owned, so like you, your wife, your, I don't know, children, friends owned 25% or more of that company at any time in the last 2 years. So we need to do first test. Firstly, the company as a non-resident, there should be 2 things so that you pay tax. The company should be UK property reach. The 75% of the value comes from UK, and you have 25% ownership of that company, including together with your connected people. Step 1, a non-UK resident sells a UK office building in 2024 with UK CGT scope. This will be within the UK CGT scope because it's post 2019 and rules cover all UK land. And you're non-resident, you are not resident of UK, but you sell UK office in 2024. So you will be under taxing of UK. And step 2, the TAR check. They try to manufacture a paper loss via circular pre-arranged sell and buy back. The disposal is taxable and the artificial loss is disallowed. So there is basically movement of capital and they are trying to evade capital gain tax, and the TAR will step in. So just once again, TAR applies to anyone who is within the CGT rules, including non-residents on UK property. So including non-residents on UK property. This is the relevant part, because you may think that only residents will be subject of corporate gain tax, but also non-residents, if they are handling with UK property, this will be also target of TAR, as it will be under corporate gain tax. And now Phoenixism, again under TAR. Some owners used to liquidate their company, take the profits as capital, like cheap CGT rates, then restart the same business in a new company. That's nicknamed Phoenixism. The business rises from the ashes. So they are liquidating their company, taking the profits with some reduced rates, because if you are doing liquidation, you only pay capital gain tax. And then you are creating the same company which does the same thing, but now you don't have your debts. The TAR stops this by reclassifying certain liquidation payouts as income, dividends rather than capital. So the TAR will classify this not as capital gain, but as income in form of dividends, and then you will pay higher tax on it. This is also important. So reclassification from capital gain to put it as a dividend. But if it is a legal liquidation without any Phoenixism and shareholders receive payments from after winding up, then those payments are not considered dividends or distribution. Distributions such as dividends are transfers to members while the company is continuing out of distributable profits. In a winding up, the company is being liquidated. The liquidator simply returns surplus of assets to members according to their rights. The Act treats this as a return of capital, not a distribution. So it will be considered as capital gain and not dividend. Let's just proceed this part and we'll go back to that. When TAR is engaged, you need all four. You had at least 5% of the company right before winding up. So more than 5% is needed. The company was closely held at same point in the 2 years before winding up. Owned, controlled by 5 or fewer people. Within 2 years after you receive the liquidation money, you carry on or help with the same or similar trade. So, the company, firstly, this point, the company was closely held. Basically, it was owned or controlled by 5 or fewer people. At some point in the 2 years before winding up. Within 2 years, so basically in the next 2 years after you get the liquidation money, not when the liquidation officially finishes, but when you get the money, you carry on, you basically create similar business, similar trade, or you help others to do that similar business with the money that you got from liquidation. It's reasonable to think a main purpose of tax winding up was to avoid reduce income tax. So on the income you usually pay income tax, and on the capital gain you pay only capital gain tax. If all four are there, the liquidation money is taxed as income, like a dividend, not as capital. Example. So we're using some assumptions below. Dividend tax rates, we have 8.75, basic 33.75 higher, 39.35 additional. And dividend allowance is 500. And capital gain tax for disposals after 30 October, 18% and 24%. So it's pretty low to compare it to the dividends. And BODER, qualified business disposals, 10% up to 5th of April, then 40% from 2025. The lifetime cap is £1 million. So Phoenix TAR, if all four conditions are met, a liquidation distribution is treated as an income distribution, dividend, and you will get this higher taxes of dividends. But the dividends taxes are discussed in income tax topic. And HMRC will not apply the CGT, this lower taxes, to your income. So cash you receive on winding up is 280,000. Your share base cost 80,000. This no gain slice is protected, not caught by the TAR carve out. Amount above base cost is 200,000. So if BODER applies, this BODER qualified business disposal. If BODER applies for 2026, it's 18%. Then capital root, no TAR, will be 200,000 multiplied with 18%. So you will have to pay 36,000 corporate gain tax. If TAR bites treated as dividend, then you will pay 33.75%, and it will be not 36%, but it will be 36,000, but it will be 67,000. So the whole purpose of this is to show that with capital gain tax, you will pay lower amount, and with dividend, you will pay higher amount. And if butter doesn't apply, because butter, it reduces the qualified business disposal, the percentage. But this is not relevant right now, because the only thing we're trying to understand is that capital gain tax will be less compared to dividend tax. And HMRC understands that, and this fanaticism, the main purpose of it is to pay capital gain tax rather than income tax or tax on dividends. That's why the HMRC will reclassify this money to income rather than as capital. But if a legal liquidation without any fanaticism will happen, then it will be still considered as capital, not as distribution. So for the fanaticism, we really need to have these 4 elements, and if they are not present, it's just capital gain and not dividends. No gain amount your share base cost. Think of your share base cost as the amount you paid for your shares. When you liquidate and receive a payout, the slice up to your base cost would give no CGT gain anyway. That slice is not treated as avoidance. Only the excess over the base cost is tested for reclassification as a dividend. Let's understand with an example. Share base cost. This was something that you basically paid for the shares yourself in order to get those shares. It's like the capital that you have inputted, and this is 80,000, which is not a gain, but it was not your income. Basically, it was something you have inputted. That's why this 80,000 will not be considered as dividend. It will still it will be no gain slice. This is no gain slice. And the rest of this 300,000, it will be 220,000, which will be then considered as dividend. So if your payout were less than 80,000, none of it would be caught by TAR, because TAR only looks for the excessive amount, more than you have inputted. Distribution of irredeemable shares. If in the winding up you receive irredeemable shares, not cash, for example, shares that cannot be redeemed for cash by the issuer, that distribution isn't treated as avoidance under this TAR. You still hold an asset. If, when you later dispose of those shares, normal CGT rules apply at that time. So irredeemable shares is not cash, it's still shares. And if one day you are able to dispose of those shares, then corporate gain tax will apply. But at that point, you are still holding an asset. So this was it for today. It was a complex topic about tax anti-avoidance. Thanks for watching, and see you in the next episode.